I want to provide a quick emergency update regarding President Trump's latest announcement. He has imposed a new 100% tariff on imports from China, effective November 1st, and also suggested canceling the upcoming meeting with President Xi that was scheduled for 2 weeks from now. This announcement came after China implemented rare earth export restrictions. The initial threat triggered a sharp market sell-off on Friday, with the S&P 500 down 2.7% and the Nasdaq of more than 3.5%. Not exactly the way you want to start a weekend. Following the market close Friday, the release of the new tariff details is expected to trigger a market correction in the near term. This escalation in the trade dispute caught markets by surprise, as recent US-China trade talks had been reported to be moving in a positive direction. Since May, the two sides have met in Geneva, London, and Stockholm, reaching agreements to lower certain tariffs and ease limits on select export-controlled items, including chips, chip design software sent to China, and the rare earth materials shipped to the US. The sudden escalation followed China's move to tighten rare earth export controls globally, expanding measures to include not only materials, but also personnel and equipment used overseas. We may now see China retaliate against the new US tariffs, potentially putting trade relations back to square one. I hope that doesn't happen, but as investors, we need to stay prepared and understand the implications. If we look back at the 2018 market behavior during the first trade war with China, stocks initially sold off in Q1 after the US raised tariff rates to 25% on Chinese goods. By the end of April, the market had bottomed, down roughly 12%. As both sides resumed negotiations in the following months, stocks recovered all their losses and reached new all-time highs by early October. However, when trade tensions between the two superpowers escalated later that year, the S&P 500 plunged nearly 20% by December, entering a bear market before a sharp rebounding in 2019. Interestingly, this year's market movements have followed a strikingly similar pattern and almost identical timing. So could we see another 20% pullback by year end? I don't think so. Well, this may be a good time for the market to let off some hot steam after an incredible bull run. Any correction will likely to be the last major opportunity this year to buy great companies at a discount. Here's why. First, companies have been preparing for the worst, shifting manufacturing away from China and sourcing from countries that already have trade agreements with the US, such as Vietnam and other Southeast Asian nations. For example, Nike has moved production to Vietnam and Indonesia, while Apple has expanded iPhone manufacturing to India and Vietnam. Many other manufacturers are also returning operations back to the US to reduce foreign dependencies. At the same time, the US government has provided investment funding to key domestic industries by taking equity stakes in companies such as Intel, US Steel, rare earth mining company MP Materials, and battery material maker Lithium Americas. Although these transitions will take time, the US is now better positioned than ever to reduce its reliance on China. Second, several major tailwinds are supporting the current economic environment, advantages that we didn't have back in 2018. The AI megatrend, often called the fourth industrial revolution, is now driving hundreds of billions of dollars in data center investments, boosting business activity across multiple sectors, from energy and industrials to technology. The impact of this AI revolution is already visible, with companies reporting real productivity gains. Enterprises are cutting operational and research costs through agentic AI, while improving operation and sales intelligence using technologies from firms like Palantir. The friendly crypto regulations, particularly the passage of the Genius Act into law, are supporting the fintech industry and fueling disruptive innovations, such as more efficient, lower-cost digital stablecoin payments and potential tokenized equity trading. And more positive regulations are on the way. Meanwhile, the newly released Big Beautiful Bill will permanently extend lower tax rates for both individuals and corporations. Additional measures, including tax relief for seniors, no taxes on tips, and expanded child credits, are expected to boost consumer spending. In addition, trillions of dollars committed in investment from private companies, both domestic and foreign, as part of the new trade deals, will help create millions of American jobs. Finally, the Federal Reserve is on our side this time, having resumed the rate cut cycle. Unlike in the 2018 when interest rate kept rising until the beginning of the following year. With these strong tailwinds in place, I believe the US is in a good position to handle another round of trade tensions with China as it works toward a more balanced relationship. That said, the only real headwind is the possibility of a prolonged government shutdown, which could start impacting consumer activity if more federal employees lose their jobs or miss paychecks. This would echo the end of 2018, when the US experienced the longest government shutdown in history, lasting 35 days. Taking a balanced view from an investor's perspective, the chance of a market correction greater than 20% seems low. A pullback in the 10 to 15% range, I believe, is more likely. And if that happens in the coming weeks, I plan to be an aggressive buyer of high quality companies at attractive prices. So stay tuned and follow my posts on this channel. I will be sharing my stock purchases and investment moves. Good luck and stay invested.